we took all of that good stuff, all of those lovely accruals that we said represented the economic reality, and we threw them out the window. I have a problem with that. Why don't we use that information to value the firm? Remember when we talked about earnings figure? And we said a company ought to be worth your stuff plus your ability to use the stuff to create wealth. That would be an uppercase sigma. I told you it was Greek letter. Value V equals book value of the company, right? Your net assets plus here's the sum of your future income, right? Should be discounted future income. Okay, we're gonna put something else into this model. If my cost of capital is 10% and my rate of return is 10%, what's my economic profit? 0. So, if we want to evaluate what the company's worth in terms of its ability to create wealth, maybe we should subtract that capital charge. Our cash flow model assumes that every dollar earned is an increase in wealth. But every dollar earned is not an increase in wealth. All right? So instead, why don't we take this and we'll subtract out what our cost of equity, right, our capital charge, and then we get the real increment of wealth, and we discount that part. Okay?
What's the name of this model?
Well, it's going to be called discounted abnormal earnings. Okay. Abnormal. Why abnormal? Economic theory would tell you that if you're able to earn rates of return higher than your cost of capital, you will attract competition. And that competition will compete with you based on price. And it will drive down your rate of return until it equals your cost of capital. So your normal rate of return is that one where you're creating zero wealth. If you're able to earn a rate of return higher than that, it would not be normal, it would be abnormal. Hence the name. Okay? So here's our deal. I'm going to put an example up here, and then you can take pictures of it. I don't know. Let's say our beginning book value was $1,000. And our cost of equity, and here we're not using the WACC, we're using the cost of equity, because earnings belong to who? Shareholders. Only earnings belong to shareholders. Right? So I've got my cost down, I'm going to say that's 10% to make the math easy. Right? And now I've got my forecast of income from my spreadsheets, whatever we had in the past. So I get your 1, 2, 3, 4, 5. Right? And then we're going to have infinity. And let's say, change colors. We got, let's say, this is beginning net assets. So this is net income, right? And we're assuming no discontinued operations or anything like that. Right, so let's say I got 110. That's just my forecast of income. It just came from your other assumption. Whatever it is what it is. Right? So, what would my normal earnings be? Normal would be my cost of capital times my beginning book value. 10% times 1,000. So my normal earnings would be 100. So my abnormal earnings would be
above
10. We forecasted earnings of 110. The normal level would be 100. Abnormal is 10. That's the amount we're going to discount.
So that's worst case.
Right?
That's kind of saying.
What would my ending book value be? I started with 1,000. How much did I earn? 110. So my ending book value would be 1110. So next year, my normal earnings, our cost of equity times the beginning book value. All right, 111.
On
What's
11.
my abnormal earnings?
11.
14. What's my ending book value?
1,225.
Okay? Everybody got it?
Why don't you go to 111?
10% times the beginning book value. Right? Beginning, the ending in this period, beginning of the next period, so forth. So here's my ending book value. Right? It's clean surplus accounting. I took what I started with and I add what I earned. Right? So I start, I've got 1235. Right? What's my normal earnings going to be next time? Let's call it 124. We'll round it up. Right, that leaves us abnormal earnings of 16, and in the end, I started with 1235, I earned 140, I've got 1375. At a 10% cost of capital, in the next period, that normal rate of earnings would be, I'm going to call that 138, and this is 22, and ending is 1535. Tell me if I do something wrong. And again, 156, actually 154. And this is 31. And then ending doesn't matter here. We got 1720. All right?
What's the 1535?
160 plus 1375. Is that right? Yeah, 14, 30. Yeah, I can go back. All right, so this part. What about orange? We don't use orange today.